Hey everybody, Scott Riley, the Market Update Desk, July 2nd. It has been kind of a wild ride the last 24 hours. There is a lot going on geopolitically across the globe, which is causing definitely issues within the bond market. We had big spikes yesterday. So yesterday we had not only spikes in our own bond market, but the entire global bond market took significant hits yesterday. A couple of reasons for that from the geopolitical aspect. You had the France snap elections, phase one. Phase two is coming up this weekend. Then we also had reactions from our own debate here for our presidential election, and a lot of rumors going on both on the Democratic and Republican side about the nominees, and it's just been really throwing a whole lot in flux. On top of all that, you had the end of the second quarter uh, over the weekend. So what that meant was there's been a couple of big hedge funds rebalance their portfolio based on what they are perceiving is a new betting favorite in the presidential election and how they interpret that downstream with potential government spending and inflation. So that really caused additional movement in the bond market. We got a little bit of a pullback from that today. We recouped maybe just 10-15% of those losses. Not a lot, but at least we're in the green today. Atlanta Fed released their new estimates for second quarter GDP. Now, keep in mind, this is revised each week. And the newest estimate showed that a very large downward revision from 3% to 1.7%. That's just in 1 week a revision of just a whisker under 50% reduction in GDP. Now, based on the size of our economy, that's like a $400 billion adjustment in 1 week. What does that mean? It's another sign of the economy slowing. In addition, we had the European conference this week on economic aspects across the world. We had one of the commentators from CNBC host a Q&A session with Chairman Powell, ECB President Legrand, and also the Brazilian head banker. So it's very interesting, different points of view, different aspects within each of their economies, but it had a similar theme to it that we're getting there, but it's, we've come down a great deal. And from here, it's a very slow movement down to where the goal is. And once again, Chair Powell reiterated for about the billionth time, dual mandate of 2% inflation and maximum employment. And getting that 2% is just probably not a realistic number in today's changed economy. So that forum was going on today. The JOLTS report came out. This was the first wave of employment data this week. The May JOLTS report showed that job openings rose a little bit to 8.1 million. The previous report that showed 8.1 million actually revised lower slightly to 7.9 million. Still the lowest level of job openings since February of 21. Leisure and hospitality open. This is kind of that linchpin of this group. Fell 146,000. The level of openings in this sector is now at 922,000. That's below where that peak level was back in February of 20. The quit rate remained at 2.2% for the seventh month in a row. It shows that there is still weakness in the labor market, as the lower quit rate means that fewer people feel confident about leaving their job and going to another one or and being poached to make more money. CoreLogic showed us that home prices appreciated 0.6% in May. That was on top of the 1.1% they showed in April and 1.2% in March. You can see this trend line of still strong home appreciation going on. And CoreLogic is anticipating June is going to be 0.7%. It's not going to end, folks. Buying a house now is going to be cheaper than in the future. The ISM Manufacturing Index for June showed that the index fell slightly from 48.5 I'm sorry, 48.7 to 48.5. Now, this was a little bit of a miss from street expectations of 49.1. This index continues to show contraction and has been under 50, which by definition is contraction, for almost 2 years now. Subcomponents of this showed that new orders rose a little bit, 3.9%, but remains significantly under the contraction at 49.3. The prices paid index, which measures inflation, this is a good thing, fell from 57 to 52.1. Now, this has been steadily falling, and that's a good sign. As we go on during the week, we've got the ADP payroll tomorrow. We have jobless claims. Now, remember, tomorrow's a shortened trading session. The markets close Thursday for the 4th of July. And then Friday, we get that BLS jobs report. So it's been a really crazy week between what the market is doing and big players and geopolitically. Let's hold on tight, see if we can get back to where we want to be. Right now, the 10-year treasury is sitting about 4.45. Now, that spiked to about 4.51 midday yesterday. Mortgage-backed securities came back a little bit today, but yesterday's substantial downturn in mortgage-backed securities did hurt mortgage rates. Hopefully you find this helpful. The market update desk is West Michigan's singular original market news source. We hope you have a great afternoon. Give us a call with any questions, 616-293-2189.